They posted a monstrous earnings beat. They are literally carrying the AI infrastructure boom on their backs, and yet FedEx stock just fell off a cliff in after-hours trading. It is June 23rd, 2026, and we are unpacking Q4 results for FedEx. Ticker FDX here on Earnings Unscripted.
Yeah, it is a really stark divide between the past 90 days and the forward outlook. The backward-looking numbers are fantastic. Revenue hit $25 billion flat, up 4.2% sequentially, and net income soared 51% to $1.6 billion.
And EPS was, what, $6.60? That is a huge jump from $4.41 last quarter.
Right. The operating margin actually expanded to 6.2% on paper. It looks like a total victory lap. But then you look at the tape and the stock gapped down almost 10% right after the bell, hovering down around that 296 range. The market saw something it really did not like.
Well, before you ruin the party completely, I should just quickly remind everyone this is all just our personal opinion and absolutely not financial advice. So please do not panic sell your logistics stocks based on us. But seriously, Mira, why the massive sell-off?
The freight spinoff hangover. Look, separating FedEx Freight on June 1st sounds great for shareholder value, but management casually noted they are now left with $600 million in stranded costs.
Oh, wow. That is a lot of leftover baggage.
Right. It's overhead they used to share across divisions, IT systems, HR, I guess mostly corporate infrastructure. They managed to reassign about $250 million of that back to the freight entity, but the express segment still has to absorb the remaining $350 million. It's essentially a direct hit to margins heading into next year.
So basically they evicted their roommate, but they're still stuck paying the full internet and electric bill.
Exactly. And on top of that, they're completely changing their fiscal year to end on December 31st instead of May 1st. So we're heading into this weird June through December transition period that makes historical comps nearly impossible to track cleanly. Wall Street despises accounting fog.
Yeah, they hate uncertainty. But honestly, underneath all that structural mass, the actual shipping trends are kind of fascinating. Did you catch Brie Carrere's comment about the data centers?
The horizontal ecosystem piece, yeah.
Yes, because we always talk about AI as just, code and software. But she pointed out they're seeing double-digit shipping growth just from physically moving massive data center infrastructure around the globe.
It's interesting because nobody really models FedEx as an AI infrastructure play.
Totally. She told this great story of walking into a meeting she assumed was a standard automotive client call, only to realize the customer had entirely pivoted a production line to build power generators specifically for hyperscalers. They need white glove, time-critical shipping just to get the heavy metal into the ground on time.
Sure, the physical world has to catch up to the cloud eventually. The problem is they have to maintain absolute perfection in their network to keep those high-margin tech clients happy, which is exactly why they're hitting the brakes on their biggest cost-saving initiative right before the holiday peak season.
All right, let's get into those details.
Right. Network 2.0. They have been selling Wall Street on this massive facility optimization for years. Integrating the express and ground networks, consolidating routes, and now Raj Subramaniam is saying, quote, "We will pause implementation until early 2027, helping us set up for a very strong peak."
Which, it makes total sense, right? You do not rebuild the airplane while you are flying it, especially not going into the holiday rush.
It makes operational sense, but financially it is, it's a major concession. You are basically admitting the transformation is too disruptive to run alongside normal daily operations.
Or they just realize they absolutely cannot afford a service meltdown right now. I think especially if they're charging premium prices for all that new tech infrastructure you just mentioned.
Yeah, exactly. Because they're leaning so hard into high-value cargo. Brie Carrere explicitly noted they are, quote, intentionally focused on growing higher-yielding cross-border volume, and that the significant majority of their incremental profit came from base price increases. So if you are raising base rates in this macro environment, you simply cannot drop the ball on service.
Right. So they are protecting the revenue engine by pushing the efficiency timeline back.
But wait, if they're delaying those cost savings, how are they handling the inflation that is still clearly chewing through the system? Because the labor pressure in this report seems wild.
That is the part the headline numbers are, actively hiding. So the operating margin looked great on paper, expanding to 6.2%, but interim CFO Claude Russ outright admitted that if you take the fuel surcharge out, their margin would have actually been down year over year.
Wow, okay. So the core business effectively got less profitable.
Precisely. They basically masked an underlying cost bleed with a 5 percentage point yield benefit from fuel surcharges. Underneath that, they got hit with massive variable compensation and higher wage rates. And the labor math is actually about to get significantly heavier.
You're talking about the pilots. I saw that in the transcript. That's a $200 million hit.
Yep. Their new labor agreement goes into effect June 29th. That is a $200 million structural headwind just sitting there for the new calendar year. And what is so interesting to me, just looking at the system dynamics, is the huge disconnect between those rising labor costs and actual fleet utility.
Meaning what? Like they are paying more for less flying?
Basically, yes. They took a $23 million non-cash impairment charge to retire 10 aircraft this quarter. 5 of those were the MD-11s, which has been this entire operational headache over the last year.
Oh, the grounding issue, because the FAA hit them with that emergency airworthiness directive recently, right? They had to just pull the entire fleet out of the sky.
Right. And to their credit, they did not just scrap them. Technical ops and safety teams spent quarters working directly with Boeing and the FAA. They actually managed to get 4 of those MD-11s rehabbed and back into active rotation just ahead of peak demand. But you step back and look at the broader system. You are retiring capacity, you are scrambling to fix grounded planes, and simultaneously absorbing a $200 million spike in pilot salaries.
That is brutal. The math just does not work in your favor when you're squeezing out less efficiency from a much more expensive labor pool. So they're effectively playing pure defense right now.
It is defense, yeah. Protect the high-yield B2B clients, stop the complex integration so Christmas goes smoothly, and just try to absorb the structural costs.
Which brings us right back to why Wall Street panicked. They look at a company that crushed its trailing numbers but is stepping straight into a swamp of transition costs and stalled efficiency.
Exactly. The momentum broke. It's a control system running at absolute maximum capacity, and management just announced they cannot afford to upgrade the cooling system until next year.
Let us see how that sets them up for 2026, though, because this whole calendar year shift brings some really bizarre guidance targets into the mix.
Bizarre is honestly the best word for it. They are telling the market to expect roughly 20% adjusted EPS growth for the new June through December period, which Raj actually framed on the call as highlighting the momentum in their business.
Right, which sounds fantastic until you realize they just changed the calendar. It is kind of like changing the grading scale right before final exams. You get an A, but what does that A actually measure now?
Exactly. The historical comps get really fuzzy, and I think the revenue guide is the real tell here. Claude Russ modeled about 11% consolidated revenue growth for 2026, but he directly noted about 3 percentage points of that is just assumed fuel surcharge benefit.
So you strip the fuel out, and the core growth is, what, 8%? Which is still, that is actually a really solid number for physical logistics. We have to give them credit where it is due.
For sure. No, the cash generation is incredibly real. They pulled capital expenditures down tightly to $3.9 billion. They plan another $1 billion in share buybacks this year, so they are absolutely defending the floor. The outlook here is basically pure yield management.
So it feels like the bigger story is FedEx officially graduating from the pandemic era obsession with sheer volume, right? They are totally comfortable moving slightly fewer packages as long as they are highly profitable B2B data center parts instead of cheap T-shirts.
Yeah, absolutely. If they can surgically cut out that remaining stranded freight cost by 2027 and just survive peak season without the Network 2.0 upgrades, they win. But it leaves them with very little margin for error. If tech demand dips or labor costs jump again, that 20% EPS target just evaporates.
Which is exactly why you hit pause on the major home renovations right before hosting a massive holiday party.
That is exactly it. Keep the planes flying, keep the high-yield clients happy, and quietly repair the balance sheet in the background.
Honestly, as far as corporate survival strategies go, I have heard a lot worse. I guess we'll see if the Christmas rush proves them right.
If you want these earnings drops to just magically show up in your feed, hitting follow in your app is probably the easiest way to do that. And just a quick note that we do use AI to build Earnings Unscripted, which really helps us compress hundreds of pages of dry SEC filings into a normal chat. We are always looking for new tickers to cover, so drop us an email at earningsunscripted@datamadness.ca, or you can find our X link right in the show notes.
Talk to you next time.